From the 1st of July 2026, the super concessional contribution cap jumps to $32,500. That is an extra $2,500 a year you can put in before tax every single year without a fight. Here is the part almost nobody checks. If your total super balance is anywhere near $500,000, that extra room can quietly wipe out unused carry-forward caps from earlier years. Caps that could be worth $142,500 in tax deductions you already earned the right to use. I have watched people do this to themselves without realizing it, right up until the letter from the fund landed. Most people hear cap increase and stop listening. They picture a bigger number and assume bigger is always better. It is not that simple once your balance gets close to that $500,000 line, because the government does not adjust that line for inflation. It has sat at $500,000 since it was introduced, while everything else around it keeps climbing. So the change that catches people out is not the shiny $32,500 headline. It is the forgotten $500,000 threshold sitting quietly behind it. Let me show you exactly how that plays out with a real example, because the numbers make it obvious once you see them side by side. If you are in that 55 to 65 stretch, actively watching your super balance and thinking about the years left before you draw it down, hit subscribe. One wrong calculation around that $500,000 line can cost you thousands, and I'm going to show you how to stay on the right side of it. The concessional cap increase to $32,500 sounds like a win on paper. But if your total super balance sat at $499,000 on the 30th of June 2025, your carry-forward capacity is locked the moment your balance crosses the $500,000 line. From that point on, you can only draw on unused caps going back to the 2021 to 2022 financial year, and that comes to a maximum of $142,500, not the full amount some people expect. Let me walk through why that happens. Because the mechanism is simpler than it sounds once you see it laid out. This is the part that changes the whole picture. That $500,000 threshold for the 5-year carry-forward rule is not indexed. It has never moved since it was introduced, while your super balance keeps growing from contributions and investment returns every single year. The new $32,500 cap actually speeds up how quickly you reach that line because you are allowed to put more in each year than before. So the very change designed to help you save more is, for some people, the thing that pushes them over the threshold sooner. Take Rob. He is 56, single, works as an IT project manager in Sydney, and had a super balance of $490,000 on the 30th of June 2025. Over the previous 5 financial years, he had unused concessional caps sitting there untouched, $27,500 from 2021 to 2022, $27,500 from 2022 to 2023, $27,500 from 2023 to 2024, $30,000 from 2024 to 2025, and $30,000 from 2025 to 2026. Add that up, and Rob is sitting on $142,500 of carry-forward room he has never used. In the 2026 to 2027 year, Rob decides to use the full $32,500 concessional cap on top of what his employer already pays in. Start with his $490,000 balance. Add the $32,500 contribution. Add a conservative $24,500 in investment earnings for the year. His balance on the 30th of June 2026 lands around $547,000 comfortably over the $500,000 mark. The moment that happens, every dollar of that $142,500 in unused caps disappears. not reduced, gone. I have watched people learn this the hard way, sitting across from a fund statement that used to show a number they were counting on, and it simply is not there anymore. Why does the rule work this way? The 5-year carry-forward system was built to help people with lower balances catch up, not to reward people who are already close to a healthy retirement balance. The trade-off is that the system uses your balance on one single date, the 30th of June, as a hard cut-off with no grace and no averaging. That is convenient for the tax office to administer, but it means one good year of investment returns, combined with one enthusiastic contribution, can cost you tens of thousands of dollars you were entitled to use. The Australian Taxation Office confirms this threshold is fixed, rather than adjusted each year the way the contribution caps themselves are. That matters because it means the gap between your balance and the $500,000 line only shrinks over time, even if you never make another extra contribution, simply because normal investment growth keeps pushing your balance upward. There is a way around this, and it is not complicated. If Rob had contributed only $10,000 in the 2026 to 2027 year, instead of the full $32,500, his balance would have stayed under $500,000, and the entire $142,500 in carry-forward room would still be sitting there for him to use in a future year when it suits him better. If your employer's payment lands late and pushes your balance over $500,000 on the 30th of June, the system treats you exactly the same as someone who chose to contribute too much on purpose, even though you had no control over the timing. But that is just the trap waiting for people who are already close to the $500,000 line. There is another change catching almost everyone this year, and it is tied directly to the new Payday Super rules that started on the 1st of July. Payday Super started on the 1st of July 2026, and it changes something most people have never had to think about before. Employers now have to pay your super within 7 business days of each payday instead of once a quarter. That sounds like nothing but good news. Faster money into your account, less waiting. Mostly it is. But there is a catch buried in the timing that can quietly shrink your own contribution room for the year. If your employer's payment for wages you earned in June lands in your fund after the 30th of June, that payment counts against next year's concessional cap, not this year's. It reduces the personal contribution space you were planning to use, and most people will not notice until they try to make a deductible contribution and find less room than they expected. I used to think Payday Super was just an administrative change, a nothing burger, the kind of update that only matters to payroll software. Then I had a client, a small business owner in Brisbane, who paid his staff's June Super 2 days late without realizing what it would do. It cost him $18,000 in personal contribution room he had been planning to use that year. I was wrong to wave it off as boring paperwork. Now I walk every client I talk to through the same 3 checks before the end of every financial year. The first check is your employer's payment date. Log into your MyGov Super account and look at the actual date each payment landed, not the date it was supposed to land. The second check is the financial year. If that payment date sits after the 30th of June, it eats into next year's cap, even though you earned the wages in the year before. The third check is your own balance. Once a late payment lands, recalculate whether you are still under that $500,000 line from the last section, because a payment you did not control could tip you over it. Let's put real numbers to it. Sue earns $85,000 a year. Her employer used to pay quarterly, and under the old system, her June quarter payment was due by the 28th of July. Under Payday Super, that same amount has to move within 7 business days of each payday instead. Say her final payday for the year falls right at the edge of the financial year, and the payment clears on the 1st of July instead of the 30th of June. That quarter's super guarantee works out to $85,000 times 12% times 3 months, which comes to $2,550. Land that payment on the wrong side of the 30th of June, and it comes off her 2026 to 2027 personal cap instead of the year she actually earned it in, dropping her available room from $32,500 down to $29,950. That $2,550 sitting in the wrong year is not just an inconvenience. At Sue's income, the tax saved on a deductible contribution that size would be about $816, using her marginal rate of 30% plus the 2% Medicare levy. That is real money she planned to save, and now cannot purely because of a payment date she never saw and had no say in. I remember sitting at my own desk late on the 30th of June one year, refreshing the ATO portal to see whether a payment had actually cleared in time. That feeling, not knowing whether a date lands on the right side of the line, is real, and it is not something you did wrong. So you have seen how the $500,000 trap and a late payment can both quietly eat into your contribution space. Now let me show you why this matters beyond just 1 year, because small missteps like these do not stay small. They compound year after year into a real gap in what you will have to live on once you stop working. Look back to 2008, during the global financial crisis. A lot of Australians stopped contributing to super altogether, spooked by account balances that seemed to shrink every time they checked their statement. The people who kept salary sacrificing through that downturn, even in small amounts, were buying into the market while prices were down. By 2012, their balances had recovered strongly, and in many cases had grown past where they would have been if nothing had happened at all. The lesson from that period was never that markets always go up. It is that people who understood the mechanism that a downturn inside a long-term retirement account is a buying opportunity rather than a disaster, made calmer decisions than people who were only reacting to headlines. The same pattern is playing out now with these new rules. React out of frustration, and you miss the mechanism. Understand the mechanism, and you can plan around it. Here is a number worth sitting with. The transfer balance cap, the limit on how much you can move into a tax-free retirement income stream, has climbed from $1,600,000 in 2017 to $2,100,000 in 2026, a rise of 31% in 9 years. That 31% increase is not random. It tracks inflation and wage growth over that period, the same forces pushing up your council rates notice or your electricity bill since 2017. But the $500,000 threshold for carry-forward contributions has stayed completely flat over that same stretch, exactly as it was the day it was introduced. That gap between a rising cap and a frozen threshold is not a coincidence, and it will not close on its own. It means the trap around that $500,000 line gets tighter every single year, even if you never change a single thing about how you contribute. None of this was built to trick you specifically, but it was built in a way that rewards close attention and quietly costs the people who are not paying attention. If you are feeling some frustration about that, that reaction is completely normal, and it deserves an honest word before we get to what you can actually do about it. When you hear that a late payment from your employer can eat into your contribution cap, or that contributing too much in the wrong year can lock you out of carry-forward room you already earned, it is easy to feel like the whole system is stacked against you. Honestly, some days it does feel that way. That frustration is real, and it is also the number one reason people give up on super planning altogether and just stop paying attention. I know a guy in Melbourne who got so frustrated after a late employer payment cost him some of his contribution room that he decided to stop salary sacrificing completely. "What's the point?" he said. But that decision cost him about $10,000 a year in tax savings he had been relying on. His reaction made complete sense in the moment. It was also expensive, and he only realized how expensive a couple of years later. I have been there too. A few years back, I missed a contribution deadline because I was dealing with family things that mattered a lot more that week than a super cap. It felt unfair at the time, like the system did not care what else was going on in my life. What I learned from that is the cost of staying frustrated and doing nothing is almost always higher than the cost of setting up one simple check once a year on one date. Instead of treating all this complexity as some kind of conspiracy against people your age, try seeing it as a filter. Most people will read a headline about a cap increase, feel good for 5 seconds, and never check their own balance against the $500,000 line. If you do just that one thing every year, on the 30th of June, you are already ahead of most people in your age group. That is not complicated. That is one date on a calendar. Here are 3 things you can actually do with everything we have covered, starting with the simplest one. First, check your total super balance on the 30th of June each year. Log into MyGov, go through to the ATO section, and look at your super summary. Write the number down somewhere you will actually see it again. If it sits below $500,000, your carry-forward caps from earlier years are still available to you. If it has crept above that line, you have lost access to the unused caps from before, but you can still use whatever cap applies to the current year. Second, check your employer's actual payment dates for the last pay period before the end of the financial year. Ask payroll directly for the date the payment left their system and landed in your fund, not the date it was supposed to happen. If it landed after the 30th of June, some funds allow a correction within limits, so it is worth asking. If not, factor that timing into how you plan your own contributions going forward. Third, if you do have unused caps sitting there, plan your own contributions so your balance, including expected investment growth, stays under $500,000, rather than maxing out the new $32,500 cap without checking first. Remember Rob from earlier. Contributing only $10,000 instead of the full cap would have kept his balance under the line and preserved his entire $142,500 in carry-forward room. Take Jane as another example. She is 58, with a super balance of $480,000 and $60,000 in unused caps sitting there from previous years. Instead of maxing out her contributions in one go, she put in $10,000 a year for 2 years, which kept her balance comfortably under $500,000 the whole time. That decision saved her about $12,000 in tax and kept the full $60,000 in catch-up room available to her. Compare that to someone in a similar position who contributed the full $32,500 without checking their balance first and lost that entire $60,000 the moment they crossed the line. None of these 3 checks take more than a few minutes once you know where to look. The hard part is remembering to do them before the 30th of June arrives, not after. If you are over 55 and working through these super changes, especially the new Payday Super timing, hit subscribe. I post a new video most weeks on exactly these kinds of traps and how to stay ahead of them. Let's bring this back to the 3 checks that actually matter. Know your total super balance on the 30th of June. Check your employer's payment timing, especially now that Payday Super has changed how often that money moves. And only push your contributions right up to the point that keeps you under $500,000 if you still have unused caps sitting from earlier years. These changes that came into effect on the 1st of July, 2026 were not designed to confuse you, even though some days it can feel that way. With 1 or 2 checks a year, you can protect thousands of dollars of contribution space that would otherwise quietly disappear. You do not need to become a tax expert to do this. You just need to know where to look and when to look. A lot of what catches people out with super has nothing to do with how much they already know. It comes down to one date they forgot to check. That is an easy gap to close once you know it is there. If you found this useful, drop a comment with your biggest question about the new super rules. I read every one, and I might answer yours in a future video.